Okay, things I'm going to talk to you about tonight are things that we actually talk about in the loan committee setting. They're real world issues that come up in part of this discussion. I love the Shark Tank video for those of you who saw that before we got started, because the people who walk in the Shark Tank, the comparison to that is your loan officer that submits your loan request. We walk into Shark Tank when we walk into loan committee. So it's really important for your loan officer to understand your business. So we're going to talk a little bit more about that. But there are a lot. Kevin O'Leary, everybody know who Kevin is, the bald guy. He's not very nice, and that's what we run into with some loan committee situations. Thankfully, not me. I've been with our organization for 19 years now, and it's a great place, but there's a lot of really good banks in our particular market area. So some of the main things, everything we talk about, will apply to one of these 5 things that we'll talk about, the 5 C's of credit. Capacity, basically that's the primary driver for the lender. Lenders are really self-centered and greedy Ebenezer Scrooge type people. All we care about is how you're going to pay the loan back. That's really important to us. So keep that in mind as you work through your business plan. And you know, they may not say that that's the most important thing. Trust me, that's the most important thing. One of the main ratios that we do in the analysis process that we'll talk about in a little while is the debt coverage analysis. And that tells us, based on your cash flow, how are you going to repay the loan back? So, but we'll talk about that a little bit more. That really is the primary decision maker. Capital, how much will you be investing in your business? That's another big thing. We want to make sure, again, we're greedy pigs. We want to make sure that you don't just walk away when things get tough. We learned back in the days when the economy was going great guns, bankers were crazy, competitive out there. We all wanted to book loans, so we started loaning people money without having any equity injection into the project. You know, it was easy for people to walk away. People lost a lot of money, banks lost a lot of money, and I blame us for that. I blame the banks for that. So we want to know what you have to lose. So we'll talk about that in the project summary, how you put that on paper. Collateral, what assets are you planning to pledge to the lender? You know, both personal assets and business assets. We want, as lenders, and if it doesn't work out the way you hope it does and the way you think it does, if it comes to a liquidation scenario, we want to be able to go and attach to or take possession of assets of the company and personal assets that are pledged as collateral, and turn around and try to resell those in order to recoup our loss. So we're going to want to talk about that as well. Conditions, what's the economic climate in your industry? That's a big deal. Coming out of a recession that we've done recently, you know, we can all remember that we had a real estate disaster. If you're in the real estate business, if you're in the construction business, when the recession hit, that was not a fun time. So the economic climate is really important. If you're a travel agent, on September 12th, 2001, when travel shut down for what, a week, 10 days, something like that, not a fun time to be in the travel industry. Character, this can be kind of tricky. What are your qualifications and credit history? Some lenders, I think, and our regulatory agencies are kind of moving us closer to being credit history, credit score driven as lenders. That doesn't tell me what your character is. It may tell me that you've had a hard time. What I'm trying to say is, if you've got issues on your credit history, we will find out. So address that in your loan package. Tell us about it. What led to that? Divorces, death in families, loss of job, disabilities. There are all kinds of justified reasons for problems that come up like that, and problems that impact your credit history. My point is, tell us about what happened, and some lenders are a little more forgiving than others. Qualifications. We want to know about you, and we're going to talk about that in a minute as well. But tell us a little bit about you and what you're all about. We're going to talk about your business plan. The real key components of what we look at in a loan request are your business plan, the amount and purpose of the loan, which may seem pretty basic, but you would be surprised at some of the packages that I've received that don't tell us that. And the financial analysis, really important components. First of all, the business plan. We're going to talk about what, who, and how. The what of that is you need to educate your lender about your business. What are you all about? Your lender may not admit that they don't know anything about your business. You have to teach them, and it's especially difficult if they don't have experience in that area. It's a two-way street when you talk to your lender. You interview them as well. Don't let them steamroll you, but you got to find out also if they're a good fit for you, not only if they think that you're a good fit for them. It is a two-way street. So educate them about what your business is all about, what you're all about. Describe your backgrounds and qualifications. That's the who. That's a really important thing, but it's not absolutely necessary that you have a lot of experience in what you plan to do. But if you've got experience in your previous life, in your previous employment history, if you've done purchasing, if you've done sales, things that can carry over from one industry to another, tell us about those. Another thing that's really important is tell us about your key people, okay? Even though they may not be an owner of your business, but if you're going to hire Sally the superstar from your competitor, tell us about Sally. Tell us about her annual sales with her existing company, her connections. It's a really big deal, and it helps to sell your loan package to your lender. And guys, it is a sales process, so keep that in mind as you're going through that. Feasibility, leads us to the next point. How are you going to sell the likelihood of success of your new business? And we're going to talk about financial feasibility, and we're going to talk. You guys are going to go through that in detail, but that's a really important thing. We want to know how you're going to get there instead of. I literally had a father and son come in and talk to me one time that wanted to get into a transportation type of business. They came in and told me that they needed to borrow $2 million for their new business. We said, okay, tell me about that business. Give me a breakdown of what you're going to need, what you're going to spend that money on. And they said, well, we don't have that worked out yet, but we're pretty sure $2 million ought to cover it. That's not the kind of thing you want to tell the banker when you're trying to borrow money. That really happened. So that's important, but we'll talk more about feasibility. Is it realistic? I'm going to encourage you to think like a banker and contingency plan. I talked about that a little bit earlier. Do some what-if analysis. What if you get sick? What if you become disabled and your key people? I happen to be a survivor of a brain aneurysm and 3 strokes 10 years ago. I would have never thought at 44 years old that would have happened to me, and in great physical condition at the time. You just never know. That's my point. If we would have been, my wife and I would have been in a small business, and if I were a key person in that business, it would have affected everything. So one way to and bankers love this kind of stuff when you contingency plan, because a little secret is they don't believe your business plan unless you really do your homework. It's really important. Here's a way to combat a disability issue is you tell your banker in your loan package, say, we know that we are key to Amy's key to this ballroom dancing, especially if John doesn't dance. Is that true?
That's true.
Oh, I'm with you. So if Amy can't instruct and she breaks her leg, it's going to be kind of tough to teach for a while. So Amy gets a disability insurance policy that pays the bank while Amy's recovering. Just that kind of contingency planning, really important. Life insurance planning, really important. And if you have in your loan package that Mr. or Mrs. Banker, we know that we're key to this operation, and just so you have a little comfort there, we are going to pledge as a collateral piece to this whole package an assignment, so we would allow you to have an assignment of this disability policy and life policy in case we become disabled or die during the term of the loan. That tells the banker that, Ebenezer Scrooge, that just cares about getting paid, that tells us we're going to get paid. And that tells us also that you're doing your homework and you're thinking, what if things don't work out the way you think they will or you plan? And we love that kind of stuff. And I talked about this already, that our meetings are two-way street. Ask your lender about expertise in your particular area, your particular industry. I will tell you up front, if you're an asphalt company, I'm not your guy, and I'll refer you to some other good lenders. I have liquidated an asphalt company, don't want to do that again. That collateral that we talked about, the assets, when we went to go get, it happened to be a bank fraud case, which made it even uglier, but when we went to get the collateral, those things, that they weigh a whole lot, which means it costs a lot of money to go get them and sell them, but they were worth literally nothing. I think we ended up getting $17,000 at auction on equipment that was supposedly appraised at about $400,000 when we did the loan. So that's a really important thing, but I can't forget about that. That's the kind of thing, if I make another asphalt company loan, I'll wake up at night, sweating and screaming. So I won't be your person. Ask your lender. That experience is really important, that they understand that. Okay, amount and purpose of the loan. How much will it cost you to start the business? How much are you going to be contributing? And how much do you need to borrow? It seems pretty elementary, but it's really important, and I've put together kind of a little project summary, and I think you have this in your packet. Hopefully this is something that you can use in this process, and I would encourage you all to go through this process and the entire business plan process, even if you're not going to need to borrow money. It's kind of like a pilot with a checklist. You go through, and the pilot knows what they're doing, and they know how to fly the thing and get that plane up in the air, but that's just a checklist to make sure they don't forget something, like when they're landing, to put the landing gear down. They know that, but they might have their mind on something else. Same thing with this. When you go through this process, even if you don't need to borrow money, you're going to do some of that what-if analysis, especially if you do borrow money from a family member or somebody close to you. That gets a little tricky. It's a little bit more burdensome than, it can make your holiday dinners a little touchy if you don't take care of things. So go through this process. So what this is, it's a project summary that lays out for you, or lays out for your lender, all the money that it's going to cost you to get into this business. And that's the total uses of funds here. The sources of funds is where's that money going to come from? But one really important thing is, when you go through this, franchise, is anybody looking at a franchise in here, by the way? No? Maybe? Okay. Franchise fees, $25,000. You know, gear this to your business. You may or may not have a franchise fee. You may not have some of these things. The point is the format and the thought process behind this. For every item you see on here, build-out construction is a great example. So somebody's doing a retail, natural beauty retail. And Brianna, with that, you're going to move into space, you're going to rent retail space, you're going to need to build that space out, customize that to what you need. So you may have to move walls, you may have to do light fixtures, you know, all that kind of stuff. Don't just tell us that it's going to cost you $50,000 to do that, because again, we don't believe anything because we're Ebenezer Scrooges. In this package, behind this worksheet, you're going to have another worksheet, right, that's going to include the itemized cost breakdown from 2 or 3 different contractors. That tells us again, you know, you've done your homework. And if you've done your homework, we're going to be less skeptical. You know, okay, so that's really, really important. Everything on this, this layout, this project summary that you're going to put together, we're going to want to see supporting documentation that helps justify these numbers. The worst thing you could possibly do, whether you need a loan or not, is to underestimate your startup costs. We've got a situation right now that one of our other lenders is working through with a medical practitioner that had 18 years of experience in another state, husband and wife couple that they're both medical practitioners. They move here, so they know what they're doing, but they started up a new practice here, and so we knew they had experience and they knew what they were doing. They didn't realize how long it was going to take them to build up a client base, patient base. And so it took them longer than they expected. They underestimated their working capital. Okay, so they've only been open a few months and they're already looking for cash. And we're tapped out. We're probably not going to loan them any more money. So it does you no good. In fact, it hurts you if you underestimate these numbers. Again, think about the what-if analysis. If you have a build-out construction cost estimate for $40,000, put $50,000 on your estimate, on the project summary. Overestimate that. If you don't need to use the money, you won't have to pay interest. You don't advance it. The bank won't advance it, so you don't pay interest on it. Okay? It's better to overestimate than underestimate. Trust me on that. Okay, so now we've got the use of funds, a total of $225,000 in this example. Then you come here to the source of funds. There's the cash injection we talked about, your capital, your equity injection. Borrower's funds, we want to see you put as much in as possible. In this example, it's 30%. Your question is, how much do I have to put into it? That can vary from bank to bank. Used to be when the economy was super strong and we didn't have many losses as lenders, that number would be less, like 10% down sometimes in some cases. More frequently, I think the SBA likes to see 33% or a third equity injection. Now that can be cash. It can also be personal assets. You know, I talked about the collateral earlier. If you have cars that have true liquidation value, if you've got home equity, those types of things that you own personally, you can pledge those towards your equity injection into the project. So you see the use of funds and your funds that you're going to inject into the project along with the bank financing, the use of funds equal the sources of funds. Okay, and again, have supporting documentation for all that information. Financial analysis. This is where the rubber meets the road for us. And back to the repayment ability issue, we want to see that on paper. And again, this is another place where if you've got a seasonal business, it's really important to show that when you do your analysis. You see, I've started out this worksheet with month 1, month 2, month 3. You're going to need to do month-to-month projections for the first few years. Not that you can really tell that, but the first 12 months are really important. If you're going to do $120,000, you estimate you're going to do $120,000 the first year in business, don't have month 1, 10,000, month 2, 10,000, month 3, 10,000. We've seen those kinds of projections, and we immediately turn the deal down because it's not realistic. You got to ramp up your sales. We know that. You really know that, but you're just trying to make it easy on yourself with these projections. Again, it doesn't do you any good if you start out with unrealistic numbers. So play with these numbers too. You know, do different levels of sales. If you think you're going to do 500,000, do a cash flow projection or sales projection at 300,000. What does that do? What's that going to require of working capital for you? What I've done here is kind of put together what I call a cash conversion cycle. What this is, it tells you how much cash you're going to generate in a given month, how much you're going to have in expenses in a given month, what you have left over, and then this is what I was talking about with the debt coverage ratio, debt service coverage ratio. So you have income, all the money coming in, cash sales, accounts receivable collection, that's what the AR is. So you have X amount of cash. Then you have your operating expenses, rent, advertising, payroll are examples of that. Then you have your inventory purchases, if you have inventory, if you're not a service business. So you've got your total uses of funds, you've got your cash available, and then you deduct those uses, obviously, out of your cash available, and that gives you this cash available for debt service number. That's what we want. We want to see a big, big number there. So do you, frankly. That's your income. But rather than pay yourself, we want to see you pay that debt service first. Debt service is just the monthly payment. So what we do, that ratio calculation is you take the cash available for debt service divided by the amount of debt service, or the amount of your monthly payment, and that gives us the debt service coverage ratio. And we like to see that at 1.3 times. Let's say what that means, you can pay all of your obligations for that month 1.3 times out of your cash flow. Does that make sense? Okay. That's really important. And we're gonna reconcile all of this with your project summary. And you guys really have to sell it. Is it realistic? We had most projections that I've seen over 30 plus years of banking. I can count the realistic projections on one hand, probably. Those that actually met their projections. It just never works out the way you think it's going to. So be very, very careful with that. You don't want to have to call us, a month after your doors open and say, Jim, I'm out of money. It's just no fun, and because you don't want to hear me say no. But we're going to reconcile all this. Rent is another, just talking about reconciling. If you, on your project summary, showed rent expense or working capital, I guess it would be in there, of a need of $45,000, and your rent is, $10,000 a month, that doesn't reconcile. And we're going to find those things. We prefer you find them first, because if we find them, we'll ask big questions, and that goes on the wrong stack. It doesn't go on the approved loan stack. Collection days. Collection days is a really important thing for those of you who don't have all cash sales. Electrical engineer, is that right? So maybe some of the projects that you complete, you're going to say, okay, Jim, I did work for you. You have to pay me in 30 days. So you do all your cash flow projections assuming I'm really going to pay you in 30 days. What if I don't? What is that? You still have to pay your rent. You still have to pay your payroll. So if I extend that from 30 days to 45 days, then I cause you all kinds of problems, and you become my bank at that point because I'm using you. I'm using your working capital. So those underlying projections, underlying assumptions in your projections are really super important. You know, and you think you're going to do 500, do those projections at 350. Do those, and everybody tells me when they hand me a loan proposal, these are really, really conservative numbers. And I know they think they might be, but I don't buy it. Normally I'll take off 15 to 20% off the top and assume all the operating expenses are accurate. Okay, so bottom line is do that what if analysis, contingency plan, and just be realistic with your proposal. Because again, it doesn't do you any good. In fact, it hurts you if you're not realistic. Okay? All right, thanks.